If you want to just be a passive investor, what that means is you're taking this money and you're just throwing it into the economy. There are funds. These are index funds, ETFs, and mutual funds. These are funds that'll give you broad exposure to the economy. For example, I'm not telling you what to invest in, but there's an ETF out there called SPY. If you buy one share of SPY, you're buying a piece of the S&P 500. The S&P 500 is a group of the 500 largest companies in the stock market. So if you're buying this, you're essentially buying a piece of the economy. There's also an ETF called VTI. VTI is an ETF created by Vanguard, which gives the exposure to the total stock market. So now you're essentially investing in all the companies that are in the stock market. Now what you can do is every time you get paid, it could be every week, it could be every 2 weeks, or it could be every month. I call that a CPA strategy, being consistent, being passive, and being automatic. Every time you get paid, your money is just automatically invested into these types of broad basket ETFs. Maybe it's the S&P 500, maybe it's the Dow Jones, maybe it's the total stock market, but you're just investing in the economy. But here's the key, and here's the mistake that so many people make. You gotta stay consistent. CPA, consistent, passive, and automatic. The key is to be consistent. And what I mean by that is we are gonna see a recession. The United States economy has seen 16 recessions over the last 100 years. That means we've seen on average more than one recession per decade. That means we've seen a lot of market crashes. But despite the recessions, despite the market crashes, the market has still gone up for the long term. But people tend to forget that when we're going through a bad period in the economy. When you're going through the bad period, people assume that things are going to collapse. I mean, we saw that happen in 2020 when markets were collapsing. We saw that happen in 2008 when markets were collapsing. And we saw that happen in 2000, 2001 when markets were collapsing. People tend to forget the markets go up and down. And so then the mistake that so many people make here is, number one, they stop buying when markets are going down. Because everybody's talking about how the economy is going to end and the markets are going to collapse and how everything is so bad, so people stop buying. And the second mistake that people make is they sell at the bottom. We've all heard buy low, sell high, but the mistake that so many people make is they buy high, sell low. But if you really want to build wealth, you have to follow CPA, being consistent, keep it passive, and just make it automatic. And that means being consistent to buy when markets are up and when markets are down, and you keep doing this every time you get paid. Every week, every 2 weeks, every month, you just keep buying no matter what. And the only change you might want to make is when markets go down, maybe use that as an opportunity to buy even more aggressively. Because when markets go down, you can buy the good investments at a discounted price. And that's when most people are running away. And the reason why that's so difficult is because everybody will tell you that you better get out now before it's too late. The whole economy is going to collapse. The world is coming to an end. People freak out. It happens every time. We've seen it happen decade after decade after decade after decade. But now that you know that, hopefully it can help you stay calm, because that's how you really build wealth, instead of being the person that just panic sells out of everything. I mean, even if you're buying stocks at the peak before the 2020 pandemic and recession hit, well, you'd still be higher today after that recession. Even if you're buying during the peak before the 2008 crash, you'd be higher today if you held on long enough. But now this requires you to hold on to a good investment, which is something like the broad economy. Now, some of you are going to say, I don't want to do what the 98% of people are doing. I don't want to just invest my money into the markets, or maybe I do want to invest some just into the markets. I want to be a little bit more involved. I want to be a little bit more fundamental and find unique investment opportunities, and that's fine. Now what you're doing is you're putting money aside to invest. And now, if you want some money to go just into the economy, fine, but you have money being put aside to invest. Now, where can this money be invested? You can invest it in individual stocks. You can invest into real estate. You can invest into a business. Those are the three asset classes that have built more wealth than anything else over the last century. Start with the things that have been time-tested and proven over the long term. Then as you start to build some wealth, now you can start to look at more speculative, more alternative assets if you want to add that to your portfolio as well. But remember, investing isn't always so exciting. Building wealth isn't always so exciting and adrenaline-y. It's something you do over the long term to really build wealth. I know the internet has kind of posed getting rich as this whole thing of getting excited and having all this hype and all this fun and just making all this money in markets, because the mistake that we're seeing so many people make nowadays is a lot of people are struggling with money because of inflation. And so you make money and you're realizing, holy crap, it's hard to live off of the income that I have. I need a way to get rich. I need a way to make some new money. And so people then find a way to put some extra money aside, and then you say, this 5-10% return a year is not that much. It's going to take me a long time to build wealth. Is there a way that I can get a 50 or 60 or 100% return on my money? That's how you start to look for the more risky assets, which can make you very rich very quickly, but you can also lose all that money just as fast, if not faster. And this is where you got to understand, this has been time tested and proven. Do this. And if you do want to be involved in the speculative stuff too, make it a piece of a portfolio, not your entire portfolio. That way, in case things go wrong, because guess what? Things can go wrong. We will see a recession. We will see a market crash. Nobody knows when, but I'm telling you it's going to happen. But some people are going to be able to get extremely rich when that happens. And in order for you to be one of the people that gets rich when that happens, you have to have money put aside to be able to invest. Now, if you're just passively investing, you just keep doing your thing. But if you want to be more active in your investments, not a trader, but more active in your investments, you have to have the money put aside to be able to actually capitalize on those investment opportunities. So if you want to become wealthy, what you have to do with your paycheck is you got to divide it up. You got to have the money that you're going to put aside to protect you against an emergency. You got to have the money that you're going to put aside to invest. That way your money can work to earn your more money because you worked really hard to get this paycheck. Now you want your money to work just as hard. And this is going to take time to compound and grow. I call it a decade of sacrifice. But if you stick with it for a decade, I guarantee you're not going to recognize yourself financially. You stick with it, you keep working to spend less and earn more so you can invest your money like crazy. Now your money is going to work to earn you some more money. And as this works to earn you more money, that's how you buy yourself the financial freedom, because then eventually your money is going to start earning you more money to the point where, well, now you can decide if you want to keep working or not, because you have the assets, you have the investments. But in order for that to work, that means you can't spend all of your money. That means you got to sacrifice the Gucci, the Louis Vuitton, and some of the vacations right now that we have our money to invest. But once you do that, now you can buy all the nice stuff that you want and not have to worry about the price, because now it's your money working to buy you those things. It's not your labor working to buy you those things. I want you to buy the nice things from your money's labor, not from your labor, because your labor needs to go to buy you some assets and use the labor that your money produces to buy you the expensive, nice, and luxury things. That's how you really build true wealth. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.